Hi again, this is Erin Geibel, and I'd like to welcome you to our second basic business finance lesson about the balance sheet. The balance sheet is one of two of the main financial documents of a company, and again, when we talk about financial documents, what we mean is the scorecards that our company can be judged or graded on. The data, the numbers that people look at to see what our business is made of, how our business is doing, and what they can compare it to. The balance sheet itself is the document that is a snapshot of the company and exactly what it looks like at a specific moment in time. As an example, if you think of a football game where the players are running, passing, going for a touchdown, and the quarterback throws the ball, the wide receiver's running into the end zone, he catches it, he falls somewhere close to the line, not sure if he's across it, if he's 1 yard away on that half-yard mark, if you will. But he thinks he made it, so he gets up and he's cheering. The balance sheet is that moment, if you could rewind it, stop it at the moment he fell and was down, and to check, was he in, was he not? All that action before and after, if you think about it, it's what's going on in the income statement, that second financial document that we'll talk about in a later lesson. But the balance sheet is that pause when it happens. Did he make it? Did he not make it? And what does everything look like right then? The balance sheet's often referred to as the accounting equation because it means your assets are equal to your liabilities and your equity. So what you have, the good things in your company, those assets, are equal to what you owe, your liabilities, plus your equity. And when we say equity, that means the money that's been invested by your investors and or the retained earnings, the money left over in the company to reinvest and or pay other debts. So balance sheet shows the condition of the company at a specific moment in time, and it's a frozen one snapshot of everything. We're going to look at now just a summarized balance sheet. We're using the Sweet Treats Bakery as an example. You'll see on the left side there all your assets. On the right side are your liabilities and equity, or in this case, it's just retained earnings. See, the balance sheet really does balance. All of those assets equal all of the liabilities. The things we look at here, if you're starting on the left there, your current assets, and by the way, we will break all these down into a little more detail on the next slide. But your current assets, that's your cash, your inventory, the most liquid assets the company has. We have these same things in our personal life. Think your cash, your bank account, your paycheck, the money that's owed to you on your pay stub is your current assets, money you will have very soon or already do have. The next item there is the fixed assets. In your personal life, once again, these are your house, your car, your property, fixed assets, good things that make up your company but can't necessarily be turned into cash right away to pay those debts. Let me pause here. I'm talking about, turning money into cash and liquidity. Why is that important? Because the more liquid your assets are, the more able they are to pay off your debts, pay off those things you owe. Eventually, you can use your house to pay off your electric bill, but it would take the electric company quite some work to recover that cash if they need to pull it out of your house. Hope that makes sense. The third thing there are other assets. This company, Sweet Treats Bakery, doesn't have any, but what those would be are, if they did, are goodwill, long-term prepaid investments. If you prepaid a 10-year lease, things would show up there. And as an entrepreneur, you may or may not have anything in this category. We have it listed there as a placement, so you know where it would be if it's there. The left side then totals up $2 million. We're not too much worried about numbers at this point. We're just talking about the items that are on this balance sheet. but we're keeping it at a nice round $1 million. Moving over to the right side, you have your current liabilities, your long-term liabilities, your retained earnings. Again, all of that totals $1 million. Assets equal liabilities and equity. So again, your current liabilities, something you have in your personal life, that electric bill you have to pay, that's your current liability. If you paid for your groceries with your credit card, current liability, something you're going to owe very, very soon. Long-term liabilities then would be your leases or your loans. Maybe you had to take out a loan to buy the equipment initially for your company. So your long-term liabilities are those that cover your fixed assets in that case. But it's money you owe, but you may not owe it within, often in accounting we talk about current being the next month or so. So your long-term ones you owe later than a month from now, but you definitely do owe it, and often they add up to more than the current liabilities because of that reason. Then we get to retained earnings. That is the money you have in your company to be reinvested to pay debt or to pay debt later in line. So again, a simple snapshot of your company. You have $1 million of assets, you have $1 million of liabilities and equity. Going into a little more detail on the asset side, again, we're talking about a bakery in this example. So the bakery is going to have things like inventory, stuff they paid money for but didn't sell yet. They're going to have equipment. They're going to have cookie ovens. They have different kinds of assets. If you look down the list here, things you'll see in just about every single company are your cash and your accounts receivable. Top two items there. Cash, pretty self-explanatory, the money you have in your bank account. Accounts receivable, you often see that abbreviated as AR. It's money that you don't necessarily have at this moment, but you will have very soon. So all of those cookies, orders this bakery sold but haven't been paid for yet are accounts receivable. Those are the things that may have been invoiced and they're just waiting for payment, or maybe haven't even been invoiced yet, just made and delivered, and you're waiting to receive on. As a manager, you need to pay attention to that number. If your receivables are growing and growing and growing, you might think of that as a good thing because you are making a lot of sales. However, if they're growing because you haven't collected, or it's days and days out, and then you need to maybe crack down on your terms of payment receipt. And then in most industries, they bill and expect payment within 30 days. However, your average payment terms aren't quite 30. Average is a little more than that. I'd say 35 to 40. Certain industries, it's even longer. I mean, in recession times when the industry's down, I worked in the oil and gas industry, it was past 90 days before you expected to receive on those. So you need to pay attention to that receivables account to make sure it doesn't grow and grow and grow out of control without your cash and growing at a good rate. Moving along, the next item there is your inventory. You can see I've indented a couple descriptive items there. This bakery wants to track inventory in a couple different ways, not just one, bam, inventory number. They want to track how much inventory is raw materials, how much is work in progress, how much is already finished cookies that just haven't been sold, and even other finished products other than that. Cookies apparently aren't their only thing. They probably have bread, they have pies, if you will, whatever. But that goes back to a point I made in some of the other lessons, that in your accounting system, you can track a lot of different things. It's up to you as the business owner or manager to ask your accountant, ask your accounting department to help you track these things. Inventory is, an out-of-the-box, crackerjack item that, here it is, here's your inventory. But if you need to track and control more than just that general inventory number, it may very well be possible that your accounting team can help you do that, or your accountant. So then on your balance sheet, all of that inventory will be summed up as a total inventory number. And then your next item, or this bakery's next item, is prepaid assets. Maybe they prepaid for some ingredients that haven't come in yet. So that number's there. It's a good thing they've spent. It's not cash anymore. They're going to get other assets. In this example, it's inventory. You just don't have it yet. You want to track that number, and it's separate from the others because, again, that liquidity thing, that those dollars have been spent on a different asset. So again, current assets even are more liquid than fixed assets, but everything within that account is also more liquid than the next, meaning you can get cash for it sooner at the top, later at the bottom. So this bakery, all their current assets is $525,000. And then we move on to their fixed assets. Again, we talked about same similar things in your personal life, your house, your real estate, your car, any tractors, lawnmowers you own. In this bakery, they want to track their real estate. They want to track their machinery and equipment. Maybe they have mixers. Maybe they have cookie ovens listed here, but they could have other ovens for their breads, their pies. Maybe they have a cash register. They have tables, chairs. All of those things are fixed because they are permanent. They're things that maybe can be sold for money, may or may not be what they bought it for in the first place, which brings me to this last line here, less accumulated depreciation. So what that means is all of these assets, they have positive values. Then this last one has a negative value, accumulated depreciation, because it decreases the value of all the other fixed assets. Your house or your car has been sitting around for a while. You've had it for a couple years. Is it worth that $30,000 you paid for it in the first place? No. It's worth something less than that. Similar situation with all of the assets in your company. That less number is called accumulated depreciation. Each period, each month, typically, assets are depreciated. You have a number you would deduct from their original amount to devalue them down to what they're worth today. So in this company, all of their assets here have accumulated depreciation or have been used, been around long enough to deduct $130,000, giving their assets a net value of $475,000. Depreciation, just one other comment here, can be calculated a couple different ways. That's another thing you want to talk to your accountant about, is how you're depreciating your assets. Some of them are over straight line method, which means the same amount is deducted each period. Some of them are double declining, meaning more is deducted the older it gets, or vice versa. You deduct more at the beginning, less at the end. Again, that's something for your accountant and you to discuss. But now that you know depreciation matters, depreciation can be different. It might be something you ask. The other thing that's different about depreciation is the length of time an asset is depreciated. I'll tell you off that land isn't depreciated at all. That will hold its value. Property, plant, equipment can be deducted over 20 years, 5 years. Computer stuff is often deducted over 3 years. So again, not something you might want to tackle on your own, but again, knowing that, you want to talk to your accountant and determine how, or just understand really, how those things are being depreciated to decide if it is right or not. And again, last thing on there was the other assets. That's blank. This company doesn't have any. That was moving on to the second side of the balance sheet there, your liabilities and equity. Sweet Treats Bakery here has $200,000 in this accounts payable. First current liability. What that means is there are companies out there that, or people that owe them up to $200,000. Something that's been, companies out there that they owe $200,000 for, something they bought and haven't paid for yet, or Utilities, they've spent and just haven't paid the balance for. Garbage pickup. That eats away at you when you have to pay for it. Next thing, there's your payroll. Everybody has people they have to pay, and even if it isn't paycheck day, you still owe people for the time they've worked. So most places will have that accrued payroll, except on actual payday itself. Income taxes payable, moving on there, is the taxes you have on your income. Just haven't paid it yet for this period. And then the last item, and under current liabilities, is your current portion of long-term debt. That portion of the second section that you owe soon, as I mentioned earlier, when we talk current, that usually means within the next 30 days, next month or so. So this bakery owes $15,000 of the long-term debt they have within the next 30 days. Important thing to remember here, as a manager, this current liability section, when you look at it compared to your current assets, I'd sure hope your current asset section is bigger, because all this current liabilities essentially will be owed within the next 30 days. So we're hoping, and we can flip back here to Sweet Treats Bakery's current assets, they do. They in fact have $525,000 to cover their $240,000 of current liabilities. Again, something you want to pay attention to. You always want to have enough assets to cover your current liabilities. Otherwise, you're going to run into some cash flow trouble, which cash flow, again, we'll talk about in a separate lesson. Moving on there, your long-term liabilities were leases, loans, things you owe in the long run. You don't owe today, you probably don't owe in the next 30 days, but you need to record. You need to keep in memory that you will owe down the line. And then the equity section, a lot of public companies have that capital stock. This company doesn't. They just have retained earnings. And again, retained earnings was the money left over after all your assets, after all your liabilities. Retained earnings is the money you have left in your company to make that managerial or owner decision. Do we reinvest this? Do we use this to cover some of those current liabilities, pay those down? Whatever it is, that is your money left. So that was an example of just the Sweet Treats Bakery that I made up myself. We are now going to switch to look at a company we all might be familiar with. The Home Depot, this home improvement company. I just want to show you quickly what a real balance sheet could look like for an existing company. If you will, they have assets just like we talked about at the top. They have their current assets. They have receivables, inventories, other current assets, just like the smaller $1 million company we looked at. Again, this is Home Depot's balance sheet, and I am using financials at morningstar.com. I just like the format of this one. There's lots of websites out there. Yahoo Finance is a popular one where you can pull up financials and look at publicly traded companies, financial documents, you know, if you were that investor that wanted to see how they were doing. We look again, just down the left here is the descriptions. Across the top are the periods we're looking at. So we're looking at different years for this company. In my example, we were looking at the month, but this is years, 2013, 14, 15, 16. You know, financials can be reported in different ways. Besides the point here, I just wanted to show you the examples, an example to see what a big company's balance sheet shows. And it's no different to that small bakery example we just looked at. Assets, less current ones here, property, land, equipment, and this big old accumulated depreciation number decreasing the value, the original value of those assets. In other assets, the Home Depot has goodwill, and they do in fact have something called other long-term assets. Smaller number here, but still something significant they wanted and needed to report. The other half of their balance sheet listed below, not right and left like I had, but same categories. We have liabilities. We have current, short-term debt, taxes, etc. You're not long-term things. You have long-term debt. You have deferred. All totaling these total liabilities here. And equity section, common stock, retained earnings. They have things such as paid-in capital, treasury stock. Again, a public company is going to be a little more detailed and need a little more in-depth tracking of the equity section. We did not cover that in today's lesson, but we will at a later point in time. Again, look here, total assets, the shaded line, always matches and balances with your total liabilities and equity section here, this shaded line. So Home Depot's balance sheet, a little bigger, a little more detailed, and believe me, I'm sure their accounting system covers it in even more detail when you dig in there. But the same concepts. Your assets equal your liabilities and equity. So flipping back here to our summary, our simplified example. Your balance sheet's that snapshot in time. It's your accounting equation. Your assets equal your liabilities and equity. It just shows what you have, the good things in your company you have today at one single point in time. Now, to interpret a balance sheet, you're going to want to use ratios. You're going to have to quantify things. So, as we saw in Home Depot example, they had different periods and all lined up right next to each other. So a good way to interpret it is to look period by period. How did things change? Did they go up and did they go down? We also will cover in a later lesson key performance indicators, or KPIs we call them. These are ratios that calculate and help you compare the condition, the financial condition or financial health of your company. There's a couple of quick examples, and we'll end with those. Your current and quick ratios. These will show whether you can cover your debt or not. As I was pointing out, can your long-term liabilities cover your long-term debt? Good question. Something we'll calculate at a later lesson. Also, your AR outstanding. We looked at that a little bit. Is this growing? Is it not? Your AR as it relates to sales. Is it a good thing or bad? Your accounts receivables, AR, excuse me. Also, inventory. If your company has inventory, you want to look at how quickly you go through that inventory, or if it's sitting for a year. Is that a good thing or is it a bad? Car company, that number is going to be a lot different, again, than this bakery. So, while we will talk about ratios and KPI, key performance indicators, there's always comparables you have to use and that work, that don't work. We'll talk about that. But as we dig into our companies, we dig into numbers, we'll start to learn that to best analyze these, you need to know your industry. But even before you can do that, you need to understand your financials, which is why we're discussing these in lessons. So that's all for today. Balance sheet, one of two financial documents. If you have time, jump right into the next lesson on the income statement or profit and loss statement, and we'll have covered two of your report cards for your business. So thanks again. Thanks for joining us, and we will see you again.